My name is Oswatitsch from DWS, heading the debt fund business, and I think switching now from the US back to Europe, and exactly, and kind of like you're looking at like the yield and inflation development. You know, obviously, we all have touched on like I think a lot of like the pieces like we're looking at here as well. It's an interesting time, right? You know, inflation, supply chain disruptions, recession fears have led to considerable volatility and impact on the fixed income market. And if we look at real estate debt as a kind of like illiquid and complex asset class compared to liquid investments, it's always kind of like here the comparison we like to make in terms of like, you know, obviously what's the relative attractiveness compared to liquid investments. And if we looked at like here on the COVID side, back when we had the COVID stress, like in 2020, right, obviously liquid investments, and here we compare it between here 7-10-year Euro government index, then investment grade index at the bottom, and then kind of like with the high yield index on the top. And kind of like we see like different increase on the liquid side, and it is so different, right? Because during COVID, we had a lot of like these like liquidity issues or covenant breaches on the ICR side, but not so much concern at the end of the day for good assets on the value side, right? And this definitely like with the combination of inflation and rising rates, this definitely feels now different. No? And looking at like real estate debt, the key question is now what's the impact here on the asset class, and like there are like obviously like the 2 points. One thing is as we touched here on the yields, and if we look at our research outlook on the DWS side, we expect about in the next 6 to 12 months about like 10% decrease in values triggered by increasing cap rates. On the long run, it's not that massive. Kind of like we had like our outlook until 2031, where we are now about 10 bips higher than in the forecast, but basically everything has moved forward now. And I think it's just interesting to see like what this means like in day-to-day underwriting, because you know, I hope no valuer here in the room is taking any offense, but to a certain extent the valuations, they look a little bit back. You know, obviously, there is like a certain sentiment that like deals are repricing, but there's not that much evidence yet. And if we look at valuations we have recently received, it's just kind of like compared to the input we get from our own equity colleagues, there is a gap, right? Because you still have like